Hello, my respected lecturer, which is Sir Ameh. Today we will be looking into Aurora Prime Berhad's financial performance over the period of 2022 to 2024. Our analysis is based on key financial ratios that cover liquidity, efficiency, leverage, and profitability. This presentation will help us understand how the company has been performing and where the risk and opportunity lies. Alright, we will move to the next, which is today's highlight. Before we dive into the numbers, here's today's highlight. Financial reports and analysis. We will examine Aurora Prime's Berhad financial data using ratio analysis. Performance of Aurora Prime Berhad. We will evaluate the company's strengths, weaknesses, and overall performance trends over the last 3 years. This will give us a clearer picture of the company's financial health. Alright, we will move to the next, which is liquidity, efficiency, and leverage ratio. Let's start with the liquidity, efficiency, and leverage position of Aurora Prime's Berhad. The current ratios was 1.43 in 2022, dropped slightly to 1.39 in 2023 and sharply down to 0.84 in 2024. This means that in 2024, current liabilities exceed current asset, which is a red flag for short-term solvency. Okay, for efficiency, inventory turnover improved from 5.26 in 2022 to 6.25 in 2023. Showing better stock management. However, in 2024, it fell to 4.76, signaling slower sales. The average collection period worsened significantly from 70 days in 2022 to 13 days in 2024, meaning customers are taking longer to pay. Asset turnover also decreased from 0.52 in 2022 to 0.47 in 2024, showing weaker asset utilization. On leverage, the debt ratio increased from 61 in 2022 to 65% in 2024. This shows the company is more dependent on debt, which increase financial risk. In summary, Aurora Prime's Berhad liquidity and efficiency weakened by 2024, while leverage increased. Okay, now let's analyze the profitability side. Time interest earned dropped from 5 times in 2022 to only 2.38 times in 2024. This means Aurora Prime's Berhad is finding it harder to cover its interest expenses. Net profit margin was stable at around 7% in 2022 and 2023, but dropped to 3.2% in 2024. This sharp decline reflects higher costs or reduced sales. Return on asset ROE declined from 3.6% in 2022 to 1.5% in 2024, showing weaker efficiency in using assets to generate profits. Return on equity improved slightly to 7.9% in 2023, but fell to 4.3% in 2024, reducing interactiveness to shareholders. So overall profitability and investor return are under serious pressure, especially in 2024. Okay guys, to conclude, Aurora Prime's Berhad financial performance shows a declining trend. Liquidity dropped to risky level in 2024. Efficiency ratio worse with longer collection periods and lower assets turnover. Leverage increase, meaning higher debts dependency. Profitability weak significantly on 2024 with lower margin, ROA and ROE. Overall, the company faced liquidity challenge, higher financial risk, and declining profitability. Moving forward, Aurora Prime's Berhad must improve cash collection, manage costs more efficiently, and reduce reliance on debt to restore financial health. I will give to the next presenter, which is FATIN FATHIAH, to continue our presentation today. That's all from me. Thank you.
In the year 2022, the company showed very strong liquidity. So the current ratio was at 2.33 and the quick ratio was 1.44, which means the company had more than enough current asset to cover its short-term liabilities. So this indicates that the company was in a safe position to pay its debts. Inventory turnover was recorded at 3.13, which means that the stocks were sold and replaced or about 2 times a year. Although this is not a very fast, it shows that the operations were stable. So the average collection period was 130 days, which is rather long and suggested that the company took more than 4 months to collect cash from customers. So from a debt perspective, the company was in a medium position with a debt ratio of 52% and at times interest earned is 5.0, showing a very strong ability to service its interest payments. So profitability was also healthy with a net profit margin of 7.2%, return on asset of 3.6% and return on equity of 7.5%. Overall, 2022 was a stable year with a strong liquidity and profitability, although receivable management still needed some improvements. In 2023, the company maintained a very strong liquidity with a current ratio of 2.11 and a quick ratio of 1.45. This shows that the company was still in a comfortable position to meet its short-term steps. Operational efficiency improved significantly. So inventory turnover has increased to 4.03, meaning that the stock was sold more frequently, while the average collection period was decreased to 120 days, showing that customers will pay more quickly. This strengthens the company cash flows. So the total asset turnover was 0.52, which means the company used its asset more effectively to generate more revenue. From a financing perspective, the debt ratio was 53% and the times interest earned was 4.92, which still reflects a safe level of debt and manageable interest payments. Profitability was stable with a net profit margin to about 7.1% and return on equity of 7.9%, which was the best performance among in 3 years. In conclusion, 2023 was a peak year for the company with higher efficiency, improved collections, and also a strong profitability. By 2024, the company's financial position has started to weaken. The current ratio fell to 1.17 and the quick ratio dropped to 0.77. This indicates that the company had very limited liquid assets to cover its short-term liabilities, this raising concerns about the liquidity itself. The average collection period has also increased sharply to 149 days, meaning it took about 5 months to collect payments from the customers. This shows a very poor of credit control and weaker cash flows. At the same time, the total asset turnover decreased to 0.47, reflecting less effective use of asset to generate the sales. The company also relied more heavily on debt, with the debt ratio rising to 65%, while the times interest earned fell to 2.38%. This suggests that the company was facing more financial pressure in servicing its interest obligations. So profitability also declined significantly with a net profit margin of only 3.2%, return on asset of 1.5%, and return on equity of 4.3%. Overall, 2024 was a warning year, showing weaker liquidity, poor receivable management, higher debt reliance, and also lower profitability. So the first recommendation is for Aurora Prime Berhad is to improve its receivable collections. In 2034, the company took about 149 days to collect the payments, much longer than the industry average. So this eventually weakens cash flow and increases the risk. By tightening the credit terms, giving small discount for early payments, and following up more actively with the customers, eventually can help the company speed up collections and strengthen the liquidity. So the second recommendation is to control operating costs. Although revenue remained the same or steady, profit fell in 2024 because of the expenses had increased. Aurora Prime Berhad should review its cost structure. You have to negotiate better with the deals with the suppliers and use technology to improve the efficiency. Reducing unnecessary costs will also help the company protect its profit margins if sales do not grow. So lastly, the company should reduce reliance on short-term debt. In 2024, debt rose to 65% and the interest coverage ratio has dropped, showing more financial pressure. By refinancing the loans, relying more on equity and managing retained earning wisely, Aurora Prime Berhad can reduce its risk, improving financial stability and also regain investors' confidence.
On this slide, we are comparing Aurora Prime Berhad's liquidity ratio with the industry average. First, looking at the current ratio, Aurora Prime record 1.17 times, which is much lower compared to the industry average of 2.2 times. This suggests the company has weaker liquidity and may face challenge meeting short-term obligation. Next, for the quick ratio, Aurora Prime stands at 0.77 times, again lower than the industry average of 1.4 times. Since this ratio is below 1, it indicates the company does not have sufficient liquid asset to cover immediate liabilities without depending on inventory. Overall, both ratios show Aurora Prime has liquidity concern compared to its peers. Now moving to efficiency and solvency. Starting with the total asset turnover, Aurora Prime achieved 47%, which is lower than the industry's 56.7%. This indicates the company is less efficient in utilizing its assets to generate sales. Next, the average collection period is 149 days for Aurora Prime compared to 105 days for the industry. This means the company takes longer to collect payments from clients, reflecting weaker credit control and cash flow management. Finally, for the debt ratio, Aurora Prime showed 65%, which is better than the industry average, 65.3%. This means the company relies less on debt financing, reducing financial risk. However, it could also indicate underutilization of debt in expanding operation. In summary, Aurora Prime struggles with the liquidity and efficiency, but maintains a relatively healthier debt position than the industry average.
Okay, in 2023, the company actually did quite well. At first, the net income was around 191,300 ringgit, which gave a margin of just over 7%. But after we adjust by 30%, the income went up to about 248,000 ringgit and the margin improved to more than 9%. So basically, there was a 2% increase in profitability. This tells us that the company was not only earning more, but also managing costs better and running more efficiently. Okay, so to wrap things up, 2023 was definitely the strongest year for Aurora Prime Berhad. Profitability and efficiency were at their best, but moving into 2024, things started to slow down, liquidity dropped, efficiency weakened, and profit fell. This shows the company need to tighten up on areas like managing receivables, controlling costs more carefully, and handling debts in a balanced way. If they can do that, there's a good chance they can bounce back and perform strongly again.